Sometimes over the weekend, the market will gap lower or higher, and the opening price on Monday will be far away from where it was when the market closed on Sunday. This is actually a good thing because market gaps can give you some incredibly easy, simple, and straightforward trades, which if executed properly can actually set you up with all of the profits you would need for a good week. In this video, we're going to go through what market gaps are, where they form, and I'm going to show you exactly how to trade them. Two different types of trades, rebalancing trades and sentiment trades. Let's get to it. So what is a gap? Well, a gap is simply a price jump, generally over the weekend or through a market break, where demand has either increased or decreased, driving the market to jump higher or sometimes jump lower, dependent on whether demand is now higher or lower than it was at the previous close. So a gap can essentially be seen as just a large candle. You can envision a large candle leaving an imbalance or an open range in the market. A gap is incredibly strong because it acts as a magnet for price. So if we've gapped up, very often the market will come down to fill that gap. Now, not every single time. Sometimes we won't fill the gap, or we'll fill the gap much, much later. But the majority of the time, these gaps are filled very quickly, which is why I say where the gap began just before the close of the market, okay, so this side of the gap acts as a magnet for price. It's a very high probability range for the market to run back through, which means we get easy potential for trades. So what we can look to do is trade the market down through this gap. The good thing about this is we only really have to look at this bit of price action where the gap has actually formed to find these isolated positions. And if you can take one of these trades on the day that the market opens, so on a Monday these gaps generally form, you can be done for the entire week off of a single gap trade. So what we're going to look for in order to sell down through the gap is what we call confirmation. We need to see the market shifting back in the direction of the gap fill in order to actually get the trade. So what we're going to be looking for is a pattern like this. We call this a standard confirmation. It's simply a phase in the market where we shift from higher highs and higher lows into lower lows and lower highs. So we're looking for the point where the market shifts from higher highs into a lower low, and then we're looking to sell this new lower high. And we sell the lower high using a supply zone. If you don't know what they are, don't worry, we'll get into it very soon as I show you the example. Okay, so we'll do it a bit dynamic. So in order for us to see that confirmational pattern here, we're going to need to work out what this structure is actually showing us. Now, if you remember what I just said, we can imagine this as one large upward candle. We can pretty much lock this in then as a piece of structure that currently looks like this. For us to get what we want to see, we need to see the market create a higher high. After the formation of that higher high, we would then need to see the market come down and create a lower low. That would then set up that confirmation we've just looked at. We would look for a supply zone. We'd sell when the market returns there, and we would target this area here. That is how a gap trade works. So what we'll do now is mark out this high. We need to see that high taken out, and we'll mark out this low. This is going to be our structural low. Essentially, we need to see a sweep and then a close. So we need to see the market push above there and then come down here, create a closure, and then we can sell. Okay. Now let's click the market forward a bit, see what we get. We have the push above. That's the first sign. And now we need to see the market come down and create a candle closure under this low, which as you can see, we have now done. So we have our standard confirmation. It now looks like this. We now want to use pullbacks to sell when the market gets a little bit higher. And we can use that to finalize what still remains of this gap, okay? At the moment, of course, we've come a fair way through this gap, but we do still have some space open. So I said we want to sell from supply zones. Now a supply zone is an indecision candle before an impulsive move to the downside or upside. Well, supply is for downside, demand is for upside. A supply zone then would be like this. This is an indecision candle. You can see the wicks either side are reasonably sized. The candle body is very small. It shows that buyers attempted to push the market higher, sellers attempted to push the market lower, but no one really made any ground. This is then the impulsive move, a very clear control from sellers indicated by these large candle bodies and this pretty much direct drive down to where we are now. So that's going to be supply zone number one. Now, supply zones have to have what we call imbalance, which is an open candle that hasn't been retested yet. So if we create one of these indecision candles and then we have an impulse away, when the market pulls back through it, that rebalances it. Essentially, treat it just like the gap. It's a new magnet area for price. So we expect this imbalance or open price range to be filled, and then we can look for a trade from there. Now, one thing we should definitely note here though, is there is another imbalance up here, and there's another supply zone up here. And this is a supply zone that we call the extreme supply. This is the furthest supply zone from price inside of this current leg of price action. So from here down to here, this is the furthest supply away. Generally, the best ones to place sell limits on are going to be extreme supply zones. So if you want to place your sell limit order, it's going to look something a little like this. You'll be selling from up there, automatic execution when the market comes into that level, and your target will be a fill of the gap. We don't have to look at demand zones, supply zones, whatever. Inside of this area, we are looking for the very point where the gap is then filled. So the perfect trade would be this. Now, because we have this other supply zone as well, we can use something called fractal confirmation to take advantage of this if we don't get the full fill. Basically, what we would do is wait for a pullback into this region, and we would look for the same confirmational pattern again to actually finalize or reconfirm that this is a good supply zone to sell from. We don't want to sell from here with a sell limit because we know the imbalance above could draw the market higher. So if we place a sell limit like this, it's got a very high probability of losing. If we use the fractal confirmation instead, if there's no confirmation in that range, we simply don't take a trade, which means we avoid a loss, which is very nice and makes us happy. So we can place a sell limit there, that trade is active, and here we wait for confirmation. If the market fills the gap straight away, that's fine, this trade is written off. But if we get the pullback, this is a very simple and easy trade for us to take. So the first area has been met with no confirmation, so no trade is taken there. We can pretty much eliminate that then. And the top supply, where we've placed our sell limit order, will trigger us into a sell as soon as the market hits that level. So at this point in time, we would now be in on a position, and what we're looking for is a continuation down to fill this range. As you can see, a little bit of a slow one today, but the market is starting to move to the downside and is coming down towards the target area. So let's just let it run through a little bit more. As you can see, we there come through and fill that target. There you go. Very simple stuff. So that is a 3.85% trade, which is done on Tuesday morning. So if you'd executed this on Monday afternoon, you've made pretty much 4% for the week. You don't need to take any more trades, which is why gap fill trades are so nice. Now, there is another type of trade that we can take from gap fills, and that's going to be the sentiment-based confirmation trade, or sentiment-based trend trade, should we call it. What we look for on a sentiment-based trade is for the market to continue in the direction that the gap was created. So as I said, a gap indicates an increase in demand or a decrease in demand. In a buying move like this, we saw price was trading here when the market closed. A new week has begun, and now suddenly price is trading up here. This means over the weekend, significant buying was basically put into the market. Significant demand has come into the market, and the market now sees a higher price as fair value. Therefore, we can expect that the market is likely, in most cases, to actually continue going higher once the gap is filled. The gap fill comes through to essentially collect liquidity or orders. But the jump in the market price from where we are here up to here tells us that buying is stronger than selling in this market. Therefore, buying from this area, the demand zone after the gap has been filled, is generally a reasonably high probability thing to do. Now, for the safety and for a more conservative approach, what we can do inside of here is look at a confirmation-based approach. Obviously, this example, it didn't happen, but I'm telling you this does happen the majority or a significant portion of the time, because if we think about the sentiment, of course, we are just moving with the trend at that point. If we've jumped up like this, we know there's a lot more demand. So in most cases, that demand will hold. And when a demand zone is hit, we will then get a rally to the upside. So if we want to trade that safely, we can trade it like this with a standard confirmation. If you want to keep it super, super simple, I do believe, but full transparency, I haven't long-term tested this, that if you executed buy limits and sell limits from the gap fill, the demand or supply zone that sits at the gap fill, with your target into the new highs, your risk reward would be so good that I believe this would likely be a profitable strategy. Now, I've been trading for about 9 years now, and I've seen this happen a lot. It oftentimes, I would say most times, does continue in the direction that the gap was created. Therefore, this would be a net positive if you consider the 5.45% risk reward. You don't need to be right a lot of times in order for this to be massively profitable, okay? If you're right on this 3 times out of 10, you're profitable. If you're right on this 2 times out of 10, you're still above break even with this risk reward. So therefore, I think buy limiting is not too bad of an idea, but if you want to be conservative, what you do is simply wait for the gap fill, wait for a standard confirmation, and that's going to lock you in. This one is definitely a profitable way to trade gap fills. So to quickly recap, we get an isolated trade when the gap is first formed, where we are looking for a standard confirmation pattern like this. When the market breaks back into the boundaries of the gap, we then look to sell supply to fill the gap. And that creates trade number 1, which in this instance was taken from here with a stop above the high and our target down into the gap fill. That's going to be around a 3.85% profit locked in. Very easy. Then we can look for another trade using this standard confirmation for the safest possible outcome to buy when the market has shifted back to the buy side and catch a trade all the way back up, which obviously then, as a sentiment-based trade, can oftentimes give you a second setup. And if you use confirmations, it's a very safe way to approach that as well. So now let's go take a look at another example. Second example, we have a gap from up here down to here. So we know that this is going to act as a magnet for price. We'll be expecting the market to return to fill this gap. That's going to be a trade up like that. That's the isolated trade. And then we know the other sentiment trade is going to be following the direction of the trend or sentiment that's set by the gap itself. Now, if we take a look what happened this time, we gapped down very significantly. We've gapped down past the previous low. So we can kind of treat this as a new structural low. But also, just understanding the sentiment, the gap alone, we closed here, we opened here. This shows a complete lack of demand in this market. Okay, demand dwindled significantly over this weekend gap. The market being priced significantly lower tells us that sellers are more active than buyers in this market at this point in time, which therefore gives us the overall bias that the likely direction for this market is going to be a continuation of further downside. All right. So trade number 1, the isolated trade up. Trade number 2, the continuation trade down. Now, let's get into the isolated trade then. In order for us to execute this position, we want to see this standard confirmation formation, as we did in the previous example. In order to get this, we of course need to see this market from where it is right now, basically create its current low, then create a high, then create a lower low, then create a higher high. So we're looking for a bit of expansion essentially, which leads into the upside, okay? So we can mark out the low of this candle because we're going to need to see this swept. We can't really validate where the high is going to be yet. It could go up more and then come down. It could go down directly from where it is, but we need to see this low go in order to provide an opportunity. Now at this point, of course, we've started to make a pullback. That would set this as our high. So in order to execute a trade, we'd need to see this happening in the market, and then we'd continue our buy through towards that point. That would be the isolated trade. If we do not get that standard confirmation, I simply let the trade pass, which as you can see is exactly what's happened here. Because what we're doing is actually just buying inside of internal structure then, which essentially, given the bearish sentiment, can flip at any time. So if we try and join it here, for example, there's nothing telling us, well, there's nothing stopping the market from just doing that next, which obviously we don't want. When we have the structural confirmation, we basically have a confirmed reversal, right? So if we had printed this, which gives us the confidence we need to hold, because we understand that this upward trending move then is actually a solidified trend rather than just a pullback corrective move. It is its own kind of trend inside of the trend. So on this day, there was no possibility for the isolated trade. That's fine. Now what we can do is look for the sentiment-based trade. Now I did say that I believe it's possible to win based on risk reward by sell limiting or buy limiting supply and demand zones. But full transparency, it's not something I do, and it's not something I've long-term tested. I've got a lot of real market experience. I've seen how these things play out, and it is a reasonably high likelihood and a high probability and high frequency that it actually does do this, which therefore makes me believe, with the risk reward being generally 5 to 7 on these continuation trades from the gap fill to the low, that it can result in a potentially positive outcome, but it's something you'd need to test. What we're going to do is play it conservatively, because this is the safer way to approach these trades. This is what I'd suggest you do if you're not going to do long-term testing on that first format. Now, what we're looking for at this point for a continuation of this sentiment after this gap fill is simply going to be the standard confirmation, but the other way, right? So we're just looking to the most recent structural low, which is going to be there. We have this wick printing a high. We have this wick printing a low. Then we have this high. So now we want to see the market come through and close underneath this low to validate downward price action. If we close under this low, that's going to validate a downtrend, which then allows us to sell when the market pulls back, targeting this low. So let's run the market forward a little bit. We can see that we come in and create closures underneath this low. The first closure is this one here. We have to see candle body closures, which means the large, thick bit of the candle has to close under the level. Wicks only show rejections, so candle body closure is essential. Now looking at where the supply zones are to sell from, we have one supply really in this trending move. It's going to be all the way at the top just here. So an indecision candle before the impulsive move, that's going to be our area of supply. We've had the gap fill, so we know there's no longer really an upward magnet to price. We can see this market sentiment is overall down. The gap also agreed with that. So now we have the confirmation, we can go ahead and place a sell limit order. Our sell limit would go there. Our stop would go over the high, so above the swing high there. Our target would go down into the low, okay? That's a simple sentiment-based trade following the new trend that has been reconfirmed by the fact that we've created this break in structure here. So now we're just hoping for the pullback, selling from the most logical position and bringing that down. That's going to be a target of around 6.4%. So every $100 risked on this position is $641 returned. Obviously, a very positive risk to reward. So as you can see, the market came in, tapped into where we wanted to get into for the entry, which would have triggered our sell trade. And then it ran down towards the low without hitting the stop because we didn't clear the high. And we've fulfilled a 6.41% trade at 1% risk there. Again, if you risked $1,000 on this on a funded account, that's a $6,410 trade, which is obviously very nice. It's a very simple format. So that's the second way to trade gaps, the sentiment-focused approach. If the market has gapped significantly down and the gap fill doesn't provide an opportunity, well, a confirmation in this direction can give you exactly what you need to trade lower. And this goes the other way as well. If we have a gap significantly up, when the market returns to fill that gap, if we start to see structure shifting back to the upside, that can be a good opportunity to jump in on a buy to take it through towards the high where the gap first opened, because this shows a gap up from here to here, a significant influx of demand, which is bullish for a currency. And when that range is rebalanced, when the gap is filled, it's then rather easy for the market to maintain that sentiment, maintain that momentum, and trade into new highs. So that is the second way, the sentiment-based way of trading gaps. So I hope you enjoyed that video. Check out the links at the top of the description for some more cool educational stuff. And if you don't want to do that, then click the video on the screen and watch that one. I'm sure you'll enjoy that. Thank you for watching. I'll see you in the next video.